Welcome to the Canadian Slovenian Chamber of Commerce Business Insights 2022. I'm Sonia Rosenworth, the Canadian Slovenian Chamber of Commerce Executive Director. Thank you for joining us today as we present Episode 1, Estate Planning, Tax Minimization, Investment Planning, and Insurance Planning for Business. Business Insights will be a series of webinars that the Canadian Slovenian Chamber of Commerce will present monthly. Our members are invited to present or to host events, and we look forward to presenting different topics of interest to you throughout the year. Now let's begin today's CSCC Business Insight episode. Today's panel of presenters are Mr. Anthony Klemencic, Mr. Stan Konda, and Mr. John Doma. All are very well-established professionals and long-time supporters within our Canadian Slovenian community. We're pleased to have them share their expertise and professional insights with us today. They'll be taking us through the elements that make the estate plan from both a personal and business point of view. The estate plan is a vital, comprehensive blueprint that includes documents that are effective during your lifetime, plus other documents that are in effect after your death. Today, we'll explore 5 main elements of the estate plan: wills and power of attorney, personal tax planning, corporate tax planning, investment planning, and insurance planning. Note also that the comprehensive estate plan includes the health care or medical directive and beneficiary designation. The experts on today's panel will be sharing their legal, financial, and accounting perspectives regarding the estate plan. So let me introduce our first presenter. Mr. Anthony Klemencic has had a very strong presence in our community for over 40 years. His law firm, Anthony Klemencic Barristers and Solicitors, has represented many of our community's families and businesses. Anthony also has been very generous with the support of Slovenian organizations and has provided legal and professional counsel for many of Southern Ontario Canadian Slovenian organizations. He was active for over 25 years in volunteer service on the board of directors of the Slovenian nursing home Dom Lipa. And when he's not lawyering, Tony is an avid recreational hockey enthusiast. Anthony will share some of his insights regarding business estate planning. Anthony, please take it away.
Take it away. Thank you very much. It is indeed a pleasure to join with you all in this video seminar. I see my very first intro to this shows me as Pauline, who is my daughter and junior in the firm. So somehow I've already undermined my own identity and got Pauline on this program twice. But rest assured, I'm Anthony, and I'm still the boss. So slide number 1, or next slide, please. Again, no information is legal advice here that we're going to be presenting. It's just a tidbit to get you into a certain issue, but each business and family situation is unique and requires specific tailored advice in order to pursue your individual estate goals. We just want to make sure you're as informed as we can make you in a very short seminar session such as this. All right, next slide. The issue that estate planning deals with are ever more complex, often don't make sense to the client, and are constantly evolving. Changes all the time. Few people object to paying taxes, but everyone should strive to pay the least amount necessary to pass their property after their deaths. This whole process of estate planning is complex, it's multifaceted, and it has a lot of cross-disciplinary issues. And especially in the business context, you do need accountants and financial planners and lawyers to be working together and to be aware of what each other is advising you so that we're going towards the same goal. I'll speak just on a couple of these items, and Stan and John can touch on the others. But in family law, you probably mostly know this, so those that have done wills already, but some of you may not. You could do a will, and if you don't do it right, or if you don't leave enough assets to your spouse, that will could be overturned, because family law does have that overriding jurisdiction in case you inadvertently leave less than half of what you own collectively to your wife or spouse. That's an important factor. Family law issues also create a concern for many clients, in that after death, sometimes it happens that clients come to me and say, well, what if I die first? And my husband gets everything and he remarries. How will I guarantee that everything does go to our children, or the people that I want as beneficiaries? And that truly is an issue that is emerging as more and more of a concern in certain settings. Also, your beneficiaries could have problems with their lives or marriages, and that may impact on how you do your will and estate plan. Another part that I'd like to touch on is the human resources part. Now, when I use that term, I'm specifically addressing the issues of the executor. Who's going to be the guy running things, or the couple, or the three people? You can have as many people as you think you need to be the administrator if you die, as in powers of attorney as well. And that can get very complicated when you are dealing with complex or multifaceted business assets. Try to find one person that has the skill, knowledge, experience, business-like, while also sensitive to personal issues approach. That's a hard thing to do. And sometimes you have to break it up into bits and pieces and segments of your world, and how that segment could or should be managed. Also, you might have to think about using a professional advisor, or perhaps an institutional executor, such as a trust company. Sometimes the stakes are just too high to leave it to someone who's going to be overwhelmed by the issue, or by the issues they face. And then the other thing that I always have to deal with clients is, well, what if the person you've chosen isn't around, or they're alive but they're not capable, they're in failing health, have other big problems in their lives such that they don't really want to carry on with that role? You have to be thinking plan A and plan B about who should be the persons or corporation, as an institutional corporation, that you're going to let these assets be administered by in case you die. And as you probably have all heard, I certainly have heard it a lot, many times when somebody's been an executor, they'll say to me after, Tony, I did it, but I don't ever want to do it again. So it can be an overwhelming, and takes a lot out of you in some cases. Valuations are also a big factor, especially when you have corporations and they've grown for years and years and decades, and it becomes hard to value them. And nobody really thinks of valuing their companies when there's no immediate urgency to do so. Companies don't typically get evaluated except when they're raising large amounts of funds to maybe do a corporate takeover or an acquisition or an expansion. But it might not be, even for estate planning purposes, it might not be a bad idea to do periodically, just so that you can sort of see the growth in the company and you can see how the evaluation process works. As you all probably know, but for you who don't, the Income Tax Act says that once you die, everything you own is deemed to have been sold at its fair market value. And that's a pretty drastic thing. When you don't even know your fair market value, and now you've died. Well, you know, evaluations are going to have to be done retroactively to the date that you died. And in these days, valuations are more complex, they take longer, and they're more expensive. So those are the issues I want to touch in on that screen. Now I'd like to move on to the next one. And these are the kind of issues that most people face when they have to think of an estate plan. And depending on your life and depending on your family circumstances, these can be pretty overwhelming, and each person will have a look at it and say, well, for me, this one's the most important. And quite often they zero in on the tax savings that they're trying to make, which of course are important to be as a goal. But sometimes there's other things that in an individual's case are equally as important and have to also be dealt with. So you've got to think of how to get that balance so that you know how to advise. You can tell your advisors, look, I've got to get this done just as much as the tax saving aspect. The part I'm going to mention on this one, and I'm going to leave most of it to John and Stan, but I'm going to talk a little bit about the tax savings in relation to the estate administration tax. The estate administration tax is kind of the modern version of what we used to call probate fees. Probate fees have been around since the mid-1900s, and they've generally fluctuated around 1.5% of a person's assets. And they're a provincial tax, not a federal tax. And so people have always thought of, well, how do I either avoid or minimize those taxes? And the number one aspect used to be that in a couple's personal lives, they would have most of their main assets, like their house, bank accounts, investments, in joint names. Having an asset in a joint name with a spouse or a child or another partner that is really meant to be a co-owner means that that asset will not be taxed under the estate administration tax because you're not the sole owner of it. However, if you, as a successful business person, have 2 or 3 companies or one massive companies, and the values that you have developed through your shareholdings in that company are in the millions and millions of dollars, well, for every $1 million, you're looking at $15,000 of estate administration tax. So you're looking for ways to eliminate it. Before I get into the corporate aspect of that, I'm just going to talk about how some people do make the error of trying to move personal assets out of their names alone to try to make them appear joint. I'm talking more about cases where you have a widow or widower who comes to me and says, Tony, I'd like to put my house in joint names with my son or daughter. And I say, well, what about the other children? Well, my son or daughter, he'll sell it and he'll divvy it up between everybody. But that can be very problematic, even though your attempt is solid. But what you're really doing is you're creating a co-ownership where a child is now part owner of your house, and that child who probably doesn't live there will end up having a taxable capital gain for whatever interest that child has been given when you try to add their name onto the title. If you've only got 6 months left to live, it's not a bad plan. But if you're simply trying to avoid 1.5% estate administration tax, it's not a good idea. Things can go off the rails. Your son or daughter can have a divorce or financial problems that will affect that interest in the property and thereby affect you too. As well as the fact that if you kept the house in your own name for the whole lifetime that you live in it, you'll have a principal capital gain exemption for that whole value that has grown over all those years. And capital gains tax will not even be an issue. So you do want to be careful in a personal setting not to try to avoid that estate administration tax by what is kind of a questionable adding of a party's name to the property. And the same goes with bank accounts. Don't go adding your child's name to a bank account and all the investments you have, because that'll just undermine the will that you probably made that says everything goes equally between your 3 or 4 children. Because once you make somebody else a joint owner of an asset, then you are basically saying, well, that's not part of my will anymore. And the will only control and govern and distribute the other assets that I have that remain solely in my name. So those are all delicate little issues that in some cases your motives are good, your intentions are good, but be careful not to do it unless it's very clear with your lawyer and with the rest of the family in writing that this is just a temporary thing you're doing and that really that asset is part of what your will should be controlling and distributing when you die. Anyway, that's enough about people's attempts to try to avoid the estate administration tax, but there's also some very legitimate and recommended ways to minimize that tax, and that is in a corporate plan to make multiple wills. Multiple wills is a kind of a new concept that has arisen in the last 25 years or so, which allow a client or allow a person in Ontario to make 2 and even more wills, depending on the way their assets are structured. Typically, it arose as a way of trying to avoid that estate administration tax, or what used to be called probate fees, because you could carve out the personal privately owned shares in privately owned corporations. And because we don't need probate, we don't need that certificate from the court to release those shares to your intended beneficiaries, it meant that you could do that by way of a second will. The second will would say all the assets I have in these corporations and all the loans that I've given to that corporation that corporation now owes me back, those I want to convey to my certain beneficiaries, probably the same beneficiaries as in your other will, but not always. Sometimes you could have different beneficiaries. I want them to be conveyed to them because we don't need a court certificate to allow the passing of those assets to the intended beneficiaries. So if you're a well-off, successful businessman and you've got 10 million in assets, that right off the bat, that's and 90% of those, or 85%, are in the corporations that you've established and grown. You're basically saving 85% of about $150,000 estate administration tax. Very useful. And in fact, in recent years, the notion of secondary wills has also expanded into the field of real estate. Real estate rules are kind of tricky, and in certain scenarios, real estate can be conveyed without the probate of the court being recorded on title, and they can become part of your secondary plan too, depending on how they were initially registered and how long you've owned them. So it's a moving target. Also vehicles. I think I had a client once that had a $850,000 race car from the 1960s that we were able to put into his secondary will because it didn't need probate the way a bank account or investment funds otherwise might need in order for a bank to release them. Very creative stuff, and multiple wills is the way to do it. Multiple wills also allow you to pick different executors. So you might say, well, you know, I've got a child who is in my business, and I would like him to then be the executor because he's going to carry on running it anyway. And I don't really need my wife to be part of being executor of that section of my assets. And that multiple will strategy allows you to do that, even though your wife may be a full beneficiary, equal with your other children in terms of the entitlement to the assets of those corporate assets when they are sold and eventually distributed. Yeah, so there's a little more flexibility there. And you can also create a bit of a trust. I think the accountant will tell you it'd be good to kind of spread out the distribution of your corporate assets and your corporate holdings over 2 or 3 years, because trying to do it all in the first year after you die can be very difficult and to accomplish. So yeah, those are very useful tools, and if you haven't done them already, you should seriously consider it. There are some careful procedures that have to be followed. You cannot do one of those on your own because there's a certain way they've got to be done. Wills are very delicate things. I tell clients too that when they have assets in another in another country, you may want to explore just how much that asset is worth, because it may be advisable to have a will done in that country for those assets. But again, that involves a little bit of interaction with your accountant professionals here, your legal professionals here, and in the other jurisdiction. Again, depending on the value of that asset, and it really involves a lot of care taken by both lawyers, so that the multiple wills that you create don't accidentally cancel each other out. Because if you recall, most wills start out by saying, this is my last will and I cancel all previous wills I've ever done. Well, that's not the way to do multiple wills. But anyway, it's a good thing. The other couple of things I wanted to touch on today is beneficiary designations. Beneficiary designations are also a way of avoiding estate administration tax, because you are in effect saying that asset, you don't have to turn to my will to see who gets it. It just goes directly to the person I've made a beneficiary. And when you've got $100,000 or $200,000 or $300,000 life insurance policy, that's a very useful tool to avoid estate administration tax and put money in the hands of your beneficiary right away. But what I see as a problem a lot is that husbands and wives will do that kind of a beneficiary designation, but they'll simply just appoint each other and appoint each other's beneficiaries. They will not, and sometimes the bank or the insurance company doesn't remind you or invite you to make an alternative beneficiary designation, so that you could say, well, but if my wife predeceases me and I'm still alive, then I want it to go to these 4 children or these 2 children or whatever. And the result of that is that if you're only making the one beneficiary designation to the most immediate next of kin, you're losing the opportunity to save on the estate administration tax, get at that money early. You're losing that opportunity if you don't concurrently with that make an alternative beneficiary designation for in case your spouse died first. I mean, you can always go into the insurance company or the bank or wherever and say, hey, I want to redo my beneficiary designation from the one I initially created. But unfortunately, many clients forget to do that. And it means the result of it is that asset then gets drawn back into probate, and you have to pay the 1.5% on that too. So beneficiary designations need a little more attention. The other thing that needs a little more attention is powers of attorney. I got to tell you how in the last 15, 20 years, powers of attorney are a really touchy thing. More and more clients are living longer. More and more are being kept alive longer because of advances in the medical world. But so that means they're a certain segment of their lives, they're alive, but not really in charge. And so the question then becomes, well, what kind of setup did they make while they still could to have powers of attorney, both for managing the property, the assets, the house, and just looking after those things for you, the will maker, because the will isn't going to help you. The will only helps after you die, and there could be 5, 6, 10 years in between those two events. So a little more attention. And if you're a business person and you've got really, really important right-hand people looking after things for you, you could structure more than one power of attorney, as long as you're careful in doing it so they don't cross each other out or cancel each other out. You could really do a good job to structure how things are going to move forward and be managed, not sold and distributed, but managed so that there's a continuity in that company's daily activities. And then, of course, there's the power of attorney for personal care, right? The one where you have a chance to express any end of life wishes that you might want to express. So I'm finding that as lawyers, we're spending way more time going over those kinds of paragraphs in a power of attorney with a client and making sure that that they are comfortable and giving them the chance to expand or compress what the standard model might say, because there's a whole lot of scope as to what you could do in a power of attorney too. So there you go. Those are, and normally we do talk about powers of attorney at the same time as a will. But again, that's sometimes they just haven't got the due attention that they should have. So I'm going to sort of close off there and with the following. Where's my very last point here? Think of it. Yeah, here we go. Estate planning is hard. It's difficult. You're facing your own mortality, and that's not pleasant. You're thinking, well, I'm happy doing what I'm doing, running my business or whatever I'm doing in my life, but it is important to do. It forces you to consider all your relationships, personal and business. It takes a lot of, not a lot, but a significant dedication of time, because you're not going to get all this stuff decided in one call or in one meeting. So it's time consuming. It's a bit of a process, but it is very important. You want the rest of your family to go back, think about you if you die as a person who really had their act together and who really put some thought into how things should go forward if this did happen. And not only that, in my experience, most people who do this, especially where they have somewhat complex issues to deal with in their lives, when they're done, most of them express a real sense of relief and gratitude that they got it done. So I think there's a payoff at the end where you will feel like, hey, this was important. I did it. I may have to review it every 5 or 7 or 8 years because I might have to tweak it depending on changes in the law and changes in my own personal life. But it was well worth it. So now, have we got to the last one, Sonia? Was there one last? I think that was my last slide. Was just the idea of keeping an eye on your will plan, reviewing it very regularly, every couple of years or so, because things do change, and if you're not doing it, it's probably more complicated in the end than you believe. So there you go. Thank you very much for your attention. I look forward to future Chamber of Commerce events like this, and to meeting you all again in person once we can do so.
Thank you very much, Tony. Our next speaker, thank you for that perspective. And now we move on to Stan Konda. And Stan, you're on deck. And I'll just share the screen here. I think before I do speaker and share. There's some information regarding Anthony and Anthony Clemencyk, barristers and solicitors. I will share this contact information later as well. Stan Konda is a principal of his firm, Konda Financial. Stan has been a financial advisor for 25 years and has hosted 13 successful annual investment seminars in the Toronto area. Many people have benefited from the investment strategies and tax savings ideas which were explained at these seminars. He's been involved with the Slovenian community in the GTA for most of his life and has been an active supporter of the VSKO, Dom Lipa, and the Slovenian summer camp. Growing up, Stan was a member of the Slovenian dance folklore group Plenika and Mladi Glas, and he attended Slovenian school to learn to read and write the language. Stan will share some of his insights regarding tax minimization, investment, and insurance planning for business. Stan, the floor is yours. Okay,
thank you for that kind introduction. Welcome everybody, and thanks for taking the time to come out and spend a Wednesday evening to learn a little bit about tax and estate planning. This is coming full circle for me because it was 25 years that I got into the business, and it was 24 years ago that I did my first investment seminar at the Brownsland Church Hall. And I'll never forget, at the conclusion of the seminar, there was a gentleman by the name of Joe Kostelik, a very successful businessman in the Slovenian community. And I said to him, I said, Joe, what are you doing here at my seminar? You're so successful and you're older, and you've done everything the right way. He said, Stan, you're never too old to learn something new. And he said, I did walk away with one or two things that I didn't know. So I hope that all of you can step away today with at least one or two items that you can use for yourselves, whether it's business-wise or in your personal life. One thing I wanted to just mention, it's a kind of a carry-on from Tony's presentation. When I'm sitting down and talking to my clients, especially my business owner clients, one thing I do mention is to make sure that they've got some kind of like an asset sheet that comes along with their will. I find that whether you're a business owner or not a business owner, I feel that a lot of people might do the right things. They may have their wills in place, they have their named executors and the whole 9 yards. Sometimes what's missing is some information as to where to locate those assets. Sometimes there's situations where it's the it's one spouse who does all the financial decisions and controls all the money and investments, and the other spouse has no idea of what's going on. And should something happen to that one individual, who's controlling and been handling the money, that could become very problematic for the surviving spouse in terms of locating those assets, understanding where they are. The children might want to come in and help that surviving parent, but if you don't know where things are at, it becomes very, very problematic. So I would definitely encourage people to have some kind of a data sheet that you can update periodically, so that should something happen unexpectedly, where to find those type of assets. And with business owner clients, some people deal with cash, and they may have large amount of cash hanging around the house or somewhere. And if you don't tell someone or list it down, it could be lost forever potentially. So I just wanted to add that one little tidbit as well. So I guess we'll continue on with the presentation. And the first topic area that I'll discuss will be on the screen in a second. It's going to be, Sonia, can you get it to the next page? Thank you. Just quickly, I know that some of this stuff might cross over to John's presentation on the accounting side, but one thing that happened last year was Bill C-208. It received approval and royal assent back in June 2021. Basically, this new bill means that transferring business shares amongst family members really became a lot more tax friendly. The seller or the transfer of the shares can now claim the small business capital gains exemption when a family member uses their corporation to take over the business shares. This is a much more tax-friendly approach than the previous mechanics of the transfer being treated as a dividend, and the sale had to also be done at arm's length with a non-family member. So there are some limitations, but for many small business owners, this new change that happened last year is going to create in some huge tax savings. Next slide, Sonia. So what is the current lifetime capital gains exemption? For 2022, it stands at just over $913,000. How do you qualify for the capital gains exemption? So just quickly, the corporation must be a qualified small business corporation to qualify. A Canadian controlled privately held corporation that uses all or substantially all of its assets in an active business carried on primarily in Canada. The phrase all or substantially all is interpreted by CRA to mean 90% or more of the company's assets must be used in active business income, in an active business. Therefore, no more than 10% of the corporation assets may be held in non-active investments at the time these shares are disposed of. The individual shareholders will each be eligible for the capital gain exemption where the corporation is a small business corporation at the time the shares are disposed of. And the shares were not held by anyone other than the taxpayer of the related persons through the immediately preceding 24 months. And then finally, there's an additional requirement that throughout the 24 months preceding the disposition of shares, more than 50% of the business must have been used in an active business carried in primarily in Canada, okay? So one question is that your accountant might bring up to you, or or maybe you're not aware of if you're looking to sell your shares, is what does the 2-year purification rule mean to qualify for the capital gains exemption? Cash that is clearly the excess to a business operation would not be considered an asset used in the active business. Remember, 90% or more of the corporation's assets must be used in active business. So purification techniques to dispose or move passive assets like cash or GSEs or mutual funds or stocks should be explored before selling your small business shares. Purification may be required before the sale. In fact, depending on how far offside the corporation is, purification may have to occur 24 months before the sale. One technique is, again, to move passive assets from an operating company to a holding company, as an example. The CDA, the capital dividend account, and how can you use that with a corporate-owned life insurance policy tax effectively? Well, the first bullet basically explains what a CDA is. A capital dividend account is a notional account that tracks certain types of income earned by a private corporation resident in Canada, and it may be distributed by the corporation as a tax-free dividend to its Canadian resident shareholders. So one popular strategy that some businesses have been using with me and with their accountants and lawyers and tax planners is to incorporate some form of corporate-owned life insurance on the business owners. And some of these policies can enjoy compounded tax-deferred growth. They have access to dividend cash values, which provides liquidity, and they eliminate annual tax receipts. And in certain strategies can offer substantial tax-free proceeds at payout. The corporation owns the policy, in this example, will pay for the policy with paying the premiums through the corporation, and the beneficiary of the policy will be the corporation itself. When the premiums are made by the corporation, it is important to note it does not trigger a taxable event to the business owner. This strategy offers the ability to move trapped taxable money in a corporation and have some or all of it paid out via the CDA tax-free. This strategy helps to provide liquidity, and in some cases, people will use it to offset estate taxes. Okay, this strategy can be still worthwhile for older retired business owner clients and individuals. Obviously, it's dependent on age and insurability. You'd have to talk to your own insurance agent to see if this is a viable option for you. Since every private business corporation is unique and different, it's always best to consult with a qualified tax accountant, insurance agent, and legal to determine if this type of strategy could make sense for you and your corporation. So what is a common mistake that I've seen by business owners make? Well, I've seen a lot of business owners that may hold term deposits or GICs, otherwise known as guaranteed investment certificates, within their corporation as an investment. Not a place to hold cash in the short term, but as a longer term investment. Your accountants will tell you that interest earned on this passive income investment will attract a 50.17% tax rate. For people or business owners who have a mid to long-term investment planning perspective, this is not really a tax effective strategy. And when I'm talking about a mid to long-term investment planning time horizon, I guess I'm talking about anywhere between 4 to 5 years plus. So, if it's a short-term investment, because you need to buy a new CNC machine, you need to buy that new building to grow your company into or whatnot, then keep it safe, I suppose. But for mid and long-term investment planning, GICs don't make a lot of sense inside a corporation, because we do know that taxes and inflation will reduce that purchasing power. So here's a slide that basically talks about what your break-even point has to be on your GIC to break even after tax and inflation. So in this example, if we look at the green bar, which represents inflation rates, if we look at the 3% mark, okay, which is in the middle, and if we go down all the way down to where the yellow bar is at 50%, so we know that corporate tax is taxed at 50%. Your GIC would have to earn 6% gross rate of return, and after tax and after inflation, you'd just be breaking even. You're actually not creating any purchasing power for yourself. As a matter of fact, information came out today that annualized CPI in Canada, up to the month of December for the last 1 year, was running at 4.8%. So we know that inflation is running even higher than the 3% example that I used. So it's really important to note that GICs follow inflation typically, not all the time, but basically you never really get ahead. Even when back in the 80s when GIC rates were really high, you have to remember that inflation was really high. And again, if you're in a 50% tax bracket and you take away the inflation rate, from your rate of return on your GIC, you're just really not getting ahead. So what's a possible solution? Well, perhaps for that conservative business owner, maybe they look at segregated funds. Segregated funds are a possible solution and a replacement to passive income investments like GICs when held within a corporation. They can offer conservative investment options with tax preferred treatment. For my clients, for the ones a little bit more conservative, balanced investments have been a popular choice, where they have a mix of stocks, bonds, and cash all rolled in within one, and they're actively managed. So here's an example of a balanced fund investment that could be offered via segregated funds. Segregated funds investments are like mutual funds, but they're offered through an insurance company. This particular balanced fund investment, and there's many that I could have selected, is called the Manulife Monthly High Income Fund. It's a value-oriented approach type to investments. It's got a management team on the left-hand side of the bar with 5 people, notable managers Alan Wicks and Jonathan Popper, who've been on the fund for many, many years. What's interesting is if you look at the calendar year returns in the middle of the screen, you can see year by year, going back to 2012, what the annual net after fee returns were on such investments. They're pretty healthy. And if you go below that, what you'll see is the compound rates of returns, what they've generated, let's say over a 6-month, 1 year, 3 year, 5 year, 10 year period. And what you notice there that over there is that over the last 10 years, you'll see that 8.25% number. That basically means that after fees, you generated a return of 8.25%. And it comes along with some preferential tax treatment. Okay. Next page, please, Sonia. So this is another example of an investment. It's called the Dynamic Equity Income Fund, which is can also be.
We'll go to, I'll just share the web page.
Okay, please do. So another alternative or another investment, another interesting investment option is offered through Dynamic, called Dynamic Equity Income. This can also be, this investment can be also purchased as a segregated fund investment. Again, this is a low to medium risk type of a profile, as you can see on the middle right hand side of this screenshot. Okay, and Oscar Balache, who was one of the 4 portfolio managers on this particular fund, has been pretty much on this fund from day one, running it since it was since its inception date back in 2000 and late 2001, 2002. If you scroll down, Sonia, and if you look at performance numbers, I'm not sure if you're able to magnify this at all, but that's fine, that's good. But you'll notice that if you go back to 2002, where these are again all net of fee rates of return, you'll notice that including the end of last year, 2021, this particular investment only lost money twice in the last 19 years. That being back in 2008 during the great financial crisis, and then in 2018, when we had that big correction happen in the last 2 to 3 months of 2018. Otherwise, this particular investment has been pretty steady and could offer an alternative to GSEs for that business owner client, if it makes sense for them. And again, below there, you can see what the compound rates of return are as well over the last 1 year, 3 year, 5 year, 10 year numbers. And since inception, they're pretty healthy numbers. Okay. So again, another interesting alternative. So we'll get back into the slide presentation again. So what are some of the other advantages of segregated funds? Well, because they are technically through an insurance company, an insurance product, they offer up to 100% principal protection in certain circumstances. There's no probate fees, which equals more tax savings. Like as per Tony's presentation, money flows directly to the beneficiary. There's no legal fees. There are no accounting fees. You've got privacy, as these assets are not on public record like most wills are. And again, it's just easy and fast movement of assets to your named beneficiary. Quick estate settlement. So this is a topic that I kind of take for granted sometimes because I know it inside out. But amazing enough, many people don't understand some of the ins and outs of tax-free saving accounts. So just to quickly go through it, this was a program that started in 2009. Every Canadian over the age of 18 with a social insurance number is able to contribute to a Tfsa. Contributions to a Tfsa are not tax deductible, and any money that you can earn, whether it be interest, dividends, or capital gains, these gains, when taken withdrawal, are all fully tax-free. So if you made money on your investment, there's absolutely zero tax to pay. There is no limit on how many Tfsas you can have for yourself, but you have to be mindful that you don't go over the personal limits, okay? Tfsa accounts, they are able to be transferred from one financial institution to another, so be mindful of that, with no tax consequences. And money borrowed to invest into a TFSA is not tax deductible. So how much money can I put into a TFSA? Well, over the years, in 2009, 10, 11, 12, the limit was $5,000 per year. In subsequent years, we can see that that number changed. In 2015, it was 10,000. 2016, 17, 18, the limits were 5,500. And in 2019 and thereafter, it was 6,000. So what does that mean? That basically means that if you've never contributed to a TFSA, now that we're in a brand new year, 2022, your cumulative max that you can put in today, if you have the resources to do so, is $81,500 per person. So it is quite substantial. The best part of this plan is, unlike your RSP accounts, any amount that you would draw from your TFSA in a particular year are automatically added back to your TFSA contribution room for the following year. Essentially, your contribution room is never lost. And also, there's no maximum age limit to invest into a TFSA. So here's the one thing that a lot of people don't understand. When you have a TFSA, let me give you an example. Let's say John invests into his TFSA every single year, and let's say his account today, he put in 81,500, but let's say over the years, he was very aggressive with his investments. And today the market value is $200,000. That's the value of his TFSA. He calls myself, he calls Stan and says, Stan, I'm pulling that money out. I'm buying myself a Ferrari. No problem. We sell the investment, $200,000 gets deposited into John's account. The gain that he made, there's absolutely no tax to pay. Now, if John calls me in a couple of months in July and says, hey, Stan, I won the lottery, I inherited some money, whatnot, I got all this money, I would look to put money back into my TFSA. The answer is no, he cannot put money back in because he's already maximized over all those years and he took out money in that given year. So what John needs to do is he has to wait until January 1st, 2023. And once that first day of January comes around, what happens? What's the TFSA room? The TFSA room will be a brand new $6,000 that John can put in, plus the market value of what he took out the previous year. So if that market value of what he sold the previous year was $200,000, in my example, John's TFSA room for 2023 is $206,000. It's crazy. A lot of clients don't understand that part of it. And so it's very important to note that you do want to grow that money in your TFSA, provided it is a mid or a longer term type of investment. Okay. Next page. So again, I touched upon this a little bit. How will your TFSAs be taxed? What happens at withdrawals? There's no tax to pay on your gains. All your gains that accrue inside are tax exempt. You'll have to wait until the following year to recontribute to your TFSA, and you cannot claim any capital losses. So, if you were very aggressive and you lost money on your TFSA investment and you sold it, there are no capital losses that you can claim. Okay. What happens if I over-contribute to my TFSA? You have a 1% penalty that will apply for each month on the dollar amount that you are over the allowable limit. So it's very important for you to keep track of your accounts along with your financial advisor, especially if you have multiple TFSA accounts. So please be aware that if you do have an account at the credit union, one at the bank, and one with your advisor, collectively, you cannot go over the limits, okay? So I know that some of my clients, I know I will always ask if they have money elsewhere. Sometimes at other institutions, they may not ask those questions, and you may go over those limits. So be mindful of that. Does the TFSA have any effect on my income tested government benefits? Well, the government announced that withdrawals made from a TFSA are not considered income, and so therefore they have no impact on government benefits or credits like CPP, GIS, old age security, employment insurance, etc. Okay, so they will not add to your taxable income. what can I invest into? Well, a TFSA will allow you to invest basically into the same broad list of qualified investments permitted for RSPs. These will include GICs, term deposits, bonds, mutual funds, stocks, just to name a few. What happens if I become a non-resident? Well, if you become a non-resident and live outside of Canada, you can still hold your TFSA and continue to benefit from the tax exemption on investment income and withdrawals. However, you will not be able to contribute to your TFSA, and no TFSA contribution will continue to accrue for you until the year you return back to Canada. Okay. The last bullet point here is what happens at death, beneficiary designations. Well, individuals are able to name a surviving spouse or partner as their successor account holder, which is kind of like a beneficiary designation, except when you have a spouse in the TFSA world, we call it a successor account holder, in which case the TFSA will continue to be tax exempt. The assets of the deceased individual's TFSA can then be transferred to the surviving spouse without affecting the receiving spouse's TFSA contribution rule. So essentially they can have double the amount that the average individual has. You can also make a beneficiary designation within a TFSA, which in many cases will be the children, which also helps to avoid probate taxes. So on many TFSA applications, you can name a successor holder, which is your spouse or partner, and then you can list your beneficiaries, which are usually the children. I'm not going to get too much into RSPs, but on the spousal RSP front, spousal RSPs offer a tax break to business owners and can be received, that tax break is received if a business owner invests into their spouse's RSP account. This is called a spousal RSP. Contribution limits are based on the business owner's RSP contribution limits and not the spouse. So quite often I'll have people say, hey, my spouse has $100,000 of room. Can I put that in? No, it's based on your room that you're putting in for your spouse. And finally, if there's anything that's tricky about spousal RSPs and taxation, is be mindful of the 3-year attribution rule. This basically means if you put money in for your spouse has to wait 3 full years from the last date money was put in. Otherwise, that income will be taxed to the contributing spouse and not to the spouse. So make sure the money's in there for at least 3 years. Finally, it's like every RSP season, you start to see these Questrade and Wealthsimple commercials. In my opinion, again, this is my opinion, they're very misleading commercials. They talk about save your money, retire wealthier, save 30% of your money. And for people that, and many of my clients, business owners or non-business owners, they don't really understand what they're getting at here with these commercials. But these investments are really made for do-it-yourself investors, passive investors, where you just kind of, these investments that are offered are all a collection of ETFs, exchange traded funds. They kind of mimic the markets, and there's various ones put together to create these investments. What I always tell my clients for the last 25 years is that low fees do not always mean it's a better investment. What I try to do as an independent advisor, is we try to seek alpha or value added in select money managers. And so some of them offer great downside protection. Some of them offer great alpha when it's the time to really make money on your investments. So it really depends on the individual client and what they're looking for. But a common thing that you'll hear is, passive investments will beat managed money or managed managers. And so, there's a lot of good managers out there that don't get the press or the accolades that they deserve, because some of them have been around for quite a long time and have been able to do some wonderful things and things that are above average. And so, that's what we try to do for our clients, is seek that value at that alpha. So over the years, I've been to those Questrade seminars, webinars, to understand, what they're talking about. And now that we're starting to get into a few years that these portfolios have been around, they have somewhat of a track record. And periodically, I'll keep track to see how they're performing and stack up to other investments that are available out in the open market. And so here's a comparison to debunk some of those theories about retiring wealthier. I know it's a busy chart, but on the top half of this, it talks about these different portfolios that Questrade can create for an investor. And so if we go to the last one, which is the Questrade Growth Portfolio Fund, this is mostly an equity-based type of investment. What you'll notice here is that if you look over the last 5 years, the rate of return that this portfolio generated with a collection of ETFs was 8.89%. Now, if you look at this disclaimer below this little chart, these are all returns that are gross of fees. Okay, so you'll notice they're in the asterisks. Questrade portfolios are gross performance. Okay, so once you take away certain fees, that number from 8.89 will drop even lower. Okay, the number that you see on top, the 11.43, when measured against the Fidelity Global Growth Portfolio Fund, that's a net of fees number. Okay, so that's a Series F MER. So again, a big difference when you're looking between the two. If you scroll down below here, you'll notice the balanced funds, for that more conservative type of investor who's looking at a low, medium risk profile. You'll notice that over the 5-year period, the Questrade Balanced Portfolio Fund up to end of August produced a 7% rate of return. Again, that's a gross number. If you look at two other alternatives, again, I just picked two. There's many others I could have put here. These numbers, dwarf the Questrade number. One's done 10.9, the other one's done 8.9. Where the disparity becomes even that much bigger, if we scroll down below here, Sonia, is when you're looking more at equities, more stock-based investments. And what you'll notice here is that if you look at the Questrade Growth Portfolio or the Wealthsimple Growth Portfolio Fund, if we look at the 5-year average rate of return up until August of last year, this is what they generated. Again, these are gross of fees. If you look at some of these other investments below that I've indicated here from many different companies, these are net of fee numbers. You'll see that it's a big difference. And so all I'm saying is that, past performance doesn't mean future performance will be just as good. But what I'm saying is that if you do the research on some select managers, some of these people have an uncanny ability to be very steady over time. And so, when you have this myth of, save 30% of your money or be 30% wealthier, when you look at these numbers, clearly, if those people investing into such portfolios took a closer look, they might think twice. So again, I will always tell you to talk to your investment advisor, your tax advisor, to see if this approach makes sense for you. But hopefully, this concludes my presentation, and hopefully you're able to learn, 1 or 2 good points from it today. Thank you.
I guess that doesn't. Okay, thank you, Stan. John Doma is on deck, and Mr. John Doma is the owner and managing partner at Bateman McKay CPAs and Business Advisors. With more than 30 years of public accounting experience, he's tenacious and client-focused, providing meaningful strategies and proactive advice that preserve and grow clients' businesses and wealth. Deeply rooted in the Slovenian community, John is the Honorary Consul General for the Republic of Slovenia in Canada. And in 2021, John was named a director of the board and treasurer for UCAN, which is the European Union Chamber of Commerce in Canada. He's also the chairman and director of the Canadian Slovenian Chamber of Commerce and a co-founder and director of the Canadian Slovenian Scholarship Fund. Today, he shares his insights regarding estate planning, tax perspective opportunities. John, welcome.
Thank you for that, Sonia. Anyways, I hope everybody's still awake. These are all dry topics. I'll start off with, I recently turned 60 a couple months ago, and I got this really neat email from one of my longstanding clients. And he goes, John, forget about the past. You can't change it. Forget about the future. You can't predict it. Forget about the present. I didn't give you one. Anyways, why don't we get started with this and get a little bit of a chuckle out of that one with everybody. And, you know, I just want to tell everybody, I think, geez, I'm just losing my train of thought there. But Tony and Stan have done a great job. And I just want everybody to realize that there's so much that can be discussed tonight. And same with me right now going through tax. They're just touching points that we're going to hit on. It by no means is it comprehensive that we can cover everything tonight. And again, as Stan mentioned, if you walk out of here with a couple points to talk to your advisors about, please, take this information and talk to them. Don't do these things on your own. They're very complex. And, as Tony says, they're constantly changing. So you've got to review and stay in touch with you. And don't be penny wise, pound foolish with your professionals. As Stan pointed out, you pay a fee. It costs money to get a good will done. So don't go to anybody or get a book and says, oh, I'll do my own will. You need somebody like Tony to explain all the things that you've got, especially when you have a business. Okay, no disrespect if you don't. I mean, there's, but when you have a business, it's extremely complex. You've worked very hard to get your business going. It's a very lonely place. I know for myself, when I started out, it was just myself. It was very hard. And, you build up a business. So it's important that you take care of it and try to minimize, what it will cost to move it on to the next generation. So on that note, I'll try and keep it very simple. And Sonia, if you don't mind starting with my part there, I'd be appreciated. Thank you. Okay, it stayed up, but you can get to the next one. Sorry, Sonia, thank you. Okay, so here's on the personal side, quite simple, and I think that Tony touched on it. When you pass away, you have to prepare a tax return to the date of death. And up until the date of death, what happens is there's this deemed disposition of all your properties. Now, you can flow your property if you have a surviving spouse. Okay, so that way you don't have the deemed disposition on property. And what I'm talking about is your private company, your corporation, any real estate holdings you have. And the unfortunate part is that when you do have a company and you do have real estate, you may not have liquidity, okay? And what happens is you're forced to sell something, or your executors are forced to sell something in order to cover your taxes. And again, Stan, I believe you touched on a little bit. That's why you might get life insurance, because it provides liquidity. There's nothing worse than having your executors forced to sell property in a downspin in the economy. That if all of a sudden prices are dropping, which we haven't experienced that in 10 years now, since 2008 there, or 2009. You want that life insurance side. Just as an aside, you should look for life insurance. And again, if you have a surviving spouse, you can elect to put it, transfer to them at original cost. You could also file the capital gain on your final returns. There might be some reasons to do that on your final return. Again, a tax advisor will take a look at that and assess that whole situation. You also have the option to prepare a rights and things return. Now, a rights and things return is a return where you have a right to something, but it gets paid after death. And where oftentimes that really works well for a business owner is you could declare the dividends prior to your death that end up getting paid after death and end up being included in a separate return. And the nice thing about rights and things returns is you get to benefit from the marginal rates, okay, marginal tax rates. So you're not paying everything at the highest rate, when you're going through these things. And it allows, your beneficiaries to, file this return and extract, money at a more efficient rate on that side. The other area that you should look at is creating a testamentary trust on death. And we still in Canada have a 3-year period where you can extract money or make money and pay marginal rates. So for example, I might have a child that has a job making $100,000 a year, and out of my estate, they might get, let's say, $100,000, and they make dividend income from it, $20,000 or $30,000. Well, what happens is when that $20,000 gets added to their return, they could be paying 30, 35% tax. If it's sitting in a testamentary trust and it's invested in the trust, then it'll pay marginal rates. So it'll still be eligible to pay tax at the lower rates within the trust and then be able to have more money available to you. So again, this is something that, we used to enjoy these testamentary trusts for many, many years. Although, a couple of years ago, the Canadian government limited to just 3 years. So, when you've got a lot of extra cash or investments, look to set this up for the benefit of your kids, because they'll end up paying lower tax, by setting up these testamentary trusts and have the beneficiaries, being your children or anybody else. It doesn't always have to be your children. It could be other people that were important in your life that, while you were not well, they were helping you, and you can also put them as beneficiaries as well. Okay, so next one, please, Sonia. Okay, a little bit about disposition of capital property that we spoke about there. Generally speaking, as a business owner, and I'm also got in here farm corporations. So if you're a qualified private company, corporation, and qualified farm corporation, you can get this capital gains deduction that Stan touched on, where you can have $900,000 of capital gains that are not, that you get a deduction, you don't pay tax. Now, also everybody should realize that I don't have that written in here. There is a minimum tax that is refundable, and you have to be aware of that it's not completely free. There is a minimum tax that you end up paying when you have these dispositions, and you could be subject to some tax. However, you've got 7 years to have income where you can get that minimum tax back. Again, discuss it with your tax advisor. So don't always think it's all completely tax-free, okay? But I do also want to state that there are non-qualifying corporations, and remember, that's these shares that you've got in public companies. They don't have the capital gains deduction. Again, that only applies to qualifying Canadian controlled private corporations. You also will have situations where you might have sold your business and you've got a corporation that's got $2-3 million in it. Well, those types of corporations don't qualify for this capital gains deduction, okay? There could be some tax planning techniques you could have done when you did have an operating company to, freeze the value or crystallize the value of the shares, and then that way they could qualify. Again, fairly comprehensive, but you should be talking to your tax advisors and your accountants about, crystallizing capital gains while you have an operating and qualifying company. Okay. Okay, Sonia, next one. Okay, I believe Stan, you touched on this and you had a very comprehensive, simplified a little bit. Qualifying corporations, it's important to be qualifying. So there's this 24-month holding period you've got to have. So if you've done a reorganization and you issued new common shares, there's, if you didn't hold them for 24 months, you may not qualify if you subsequently sell the company. But there are ways of doing this reorganization where you'll get, and again, important that your tax advisor knows that. You've got to be a qualifying Canadian controlled private corporation. That means you have to have active income that you derive from business, selling products, doing services. It's not income derived from passive income where you're making returns on GICs, investment companies and things like that. They do not qualify. On the closing side, when you close the sale of the business, you can't have more than 10% of the assets in what we call passive assets. Again, Stan touched on that. So you can get your company to qualify the day before by extracting funds out of the company, so you take advantage of the $913,000 capital gain. So that's sort of nice because you can do that the day before. Again, look with your advisor, and you can manage that part of the closing when you close the deal. The one that's a little bit more trickier is the 50% rule, and that goes back over 24 months. So it's always important, if you come into quite a bit of cash that's over and above what you need in your business, you'll want to take a look at that and talk to your advisor and extract it, especially if you're thinking of selling the business in 24 months. So, there's a test that you do back for 24 months. Again, keep an eye on that, especially right now. Some people may have had quite a bit of cash in their business. They might want to be looking to sell it. You know, so just be wary of that test as well. So it's not always a given that your private, you know, Canadian controlled private corporation will be eligible for this capital gains deduction. And remember, this is also important when you pass away, that your shares are qualified on that side. Okay, so that's just something I want to bring up there. I want to reiterate the non-qualifying corporations here. Rental companies. You have a corporation that's got properties, real estate in it, and you're renting to, you know, residential tenants or commercial tenants, industrial tenants. These types of companies don't qualify. As a matter of fact, I've had a lot of tax returns provided to me where they're treating these companies as active income when they should be treated as passive income. Unfortunately, then the taxation rates are 50%, very similar to what Stan mentioned about interest income. But on that 50%, if you pay out a dividend, you'll have refundable tax that comes back and brings the rate back down to 12%. But then personally, you got to pay the tax. So again, there's some planning you can do around that. Now, if you have a rental company that has 5 full-time, more than 5 full-time people, for example, 5.5, like a part-time person, then your rental company can now qualify for this capital gains deduction and for the small business deduction, where you're paying 12% or 26%, but not 50%. So again, that's, you know, that's something that, you know, you should keep in mind, but they have to be full-time, you know, when you're doing that. So that's, you know, obviously you have to, you know, accumulate a substantial amount of real estate to have, you know, 5 full-time people working for you, you know, plus on that side. But again, I just wanted to reiterate here, you know, the investment companies. So be careful with that type of scenario. Now, one caveat I'll put on rental companies that have real estate in them, most people will not buy shares of companies that have real estate in them. Most advisors will tell their clients, buy the real estate, don't buy the shares, because everybody wants to get a bump up in the real estate side when they're buying up property, because then you can depreciate that and you have a higher cost base. Okay, so just, you know, be aware of that. One really good planning technique that you could use, and this is for people who have quite a bit of net assets or investment assets, for example, outside of their company, and they might have been able to extract this money through capital dividend accounts and all that. So if I'm an individual where I'm making $200,000-300,000 a year, probably more money than I need as we get older, you know, we don't tend to spend very much. You could, and let's say you've invested in these funds that Stan's got there, and you're making 10% a year on, you know, a couple $1 million. So you're paying tax now at 53%. Okay. Now, I mean, 53%, assuming it's, you know, interest income, you're paying 26% on capital gains, and you're paying, you know, up to 40% on dividends with 33%. What you can do is you can take that money that you have, create a family trust or a trust, and you have beneficiaries there other than yourself that have low tax rates. So that, you know, there might be, you know, younger children or other people that are important to you that you want to create as beneficiaries. And what happens is the money that's earned in that trust, okay, can be allocated to those beneficiaries at a lower rate. So you're taking away the, you know, let's say a return on $1 million that you might be making 10% on, $100,000, you're paying 50% on it. You're going to turn that around and allocate it, okay, to people that are paying 10 or 20 or 30%, much less tax than you are. The only caveat is that you do have to charge, like you're lending $1 million to your trust, you do have to charge 1%, and that 1% is established by by Revenue Canada as a prescribed interest rate loan. Okay, they publish that, you know, it's usually available to. Now, the one thing you got to do though every year is that within 31 days, by January 31st, you have to actually pay the interest out of the trust. So what has to happen in the trust, you have to, you know, sell something, or the dividends that are in there in a form of cash, pay the interest. Okay, that's very important. So you got to make sure that happens, and you have to work with your investment advisor on that in order to keep this on a legitimate basis. Now, remember, inside the trust, if that trust ends up going to, you know, from $1 million to $2 million, and it grows and grows, remember that $1 million that's there is always yours. You can always pay that back anytime you want. and there's no tax involved in that. Okay, so you don't lose that $1 million. Okay, it stays as part of your estate. It's there for you in case, you know, like if you get into personal care, which gets very expensive. You know, we all, I'm sure, know of situations where, having your loved ones, looked after, it gets very expensive. So you want to make sure you have money for yourself, down the road. So that $1 million, it always goes back to yourself. And then you're able to pass on, the higher returns to your children, grandchildren that are at lower rates. Okay, so on your next. Okay, this again applies to business owners. Okay, and you're running along with your company, and your company gets to a value, let's say $2 or $3 or $4 million. You've got RSPs with $1 million or $2 million in there. You've got savings with money in there. You have a house that's mortgage free, so you don't have a lot of expenses. But what we can do is freeze your value of your private company. You still want to run the company. You don't want to retire just yet, but you say, look, if I get $4 million from the sale of my company, or I get $4 million paid out to me, what we can do as accountants and tax advisors, we can freeze the value of your company. Okay, and what we do then is create, issue new common shares that could be the family members, and we, again, Tony alluded to the fact, be careful, when you allocate common shares to your family, because then you've got to worry about spouses, you got to worry about family law, and you got to be very, very clear on how you do that. And there's strategic ways to gift shares to the children. Sometimes that's outside of the family law side. So again, you got to document all that really well. But what's nice about this is that you don't increase the value of your estate. Okay, you freeze it, and then this way, when you pass away and your company goes from 4 million to 6 million, the 2 million that rise in that price and the value of your company won't be on your final return. It gets pushed on to the next generation. Okay, so again, get advice on that. Utilize that on your front, and then you create what you can. Oftentimes, what we'll do is, if the value is 4 million, we'll give you 4 million shares. They're all voting shares, and the 100 shares you issue to your, your children, you got 4 million votes. They got 100 votes. So guess what? You're always going to win on the battle on decision making of the companies in the future. So you're still going to control the company. You still end up making the final decision, and you've got $4 million there that over time, you can do it a number of ways where the kids will buy the shares with you using the holding company, as Stan brought up. So they can do it that way. It might be decided that buying back your shares is a redemption. They won't qualify then for the capital gains deduction, but you might get the benefit of the marginal tax rates, the tax credits from dividends. And it's usually better for the person buying you to do it that way, being your kids. So again, get your tax advisors to look at that. And that's what I mentioned, the redemption of special shares. But remember, when it's being redeemed by your company, then it's treated as dividend income. You're not eligible for the capital gains deduction. That will only happen should somebody buy your shares, your special shares. They're still eligible, provided the company's eligible. Okay, so I think that's what enough about that there. Okay, a little bit about things you can do and what you can do and what happens when you pass away. We've got what we call post-mortem planning options. So you get to a point, you've got this investment company, okay? You and your accountant decided to keep the $2 million in the company, and you were taking out $100,000 a year or something like that, and you die suddenly. So what happens? You got a $2 million capital gain on your final return. You pay $500,000 in tax, or your executors arrange to pay the $500,000. What happens now is your children or your beneficiaries are going to get a company with $2 million in cash in it, and the shares will be valued at $2 million. And the kids go, hey, John, can I pull that $2 million out? Mom and dad already paid the $500,000 tax. I should be able to get it tax free. No, when you pull it out, it comes out to you as a dividend, and you pay 40% again. So now you're double taxed on this money, okay? If you do this over time, okay? So what we do is we advise clients, look, you're gonna pay a tax, okay? And what we suggest you do is the dividends, the cash that's in there is pulled out, you pay your tax with the dividend rate. You already paid tax 26% on the disposition of the shares. But what now happens is you create a loss because the company has no cash in it. The shares are worth zero. So you end up creating a loss. You apply back the loss. You have to do this within 12 months, okay? And then you get rid of that 26% tax, and you pay, well, I don't want to say only 40%, but you pay 40%, or whatever your marginal rates are at that rate. So that's a planning tool. So if you end up having this scenario, make sure you got your tax advisor, you all get on the same page, so your kids aren't burdened or surprised by this, in their lifetime. The other thing that we use is something called a pipeline transaction, and that's where we utilize capital gains rates. So we go from 40% down to 26%. Okay, and again, it's doing a couple transactions. I won't get into the detail of it, but you're able to utilize this with the capital gains rate of 26%. Now, I will tell everybody here, and I've talked to a lot of my clients, what really worries me with the next budget is this 26% rate, just so we all know how we arrive at that for capital gains, which is the lowest tax rate. When you make $100 in capital gain, you only pay tax on 50% of it, okay? So the 50% that you include in your income in Ontario, assuming you're making over $220,000, gets taxed at 53%. Okay, so that's how we get to this 26% rate. Now, if the Minister of Finance with the new budget comes out and says, we're increasing the capital gains inclusion rate from 50% to 75%, that rate will jump from 26% to 37%. Okay, your tax rates will go up significantly. And we do a lot of these, what we call capital gains transactions for clients right now. They're only advantageous while the rates of the capital gains inclusion rate is 50%. So take a look at that. You might, if you have capital gains in your investment corporations, trigger the gains. I know Stan hates that because now you got less money to pay and you're triggering, tax by generating these gains. But the nice thing is you create a CDA account at 50% of the gain and you're only paying 26%. And remember, 26%, about 16% of that approximately is refundable when you pay out a dividend. So you get part of that back on that side. So take a look at this, look at your portfolio between now and the budget. We're fully expecting the Canadian government looking for more money and sources of income. We're already in Ontario paying 53% at 220 grand. HSTs at 13%, that might go up in the next little while. I mean, probate fees might go up provincially, to collect more monies. So just be wary of that and talk to your advisors, talk to your investment people about, taking advantage of these programs. I think on that note, Sonia, I think everybody's tired of listening to me. Is there anything else I got left?
No, thank you. Thank you very much. Actually, so we will share the contact information for all three speakers. Everybody that has registered, I'll be sending you a slide with the contacts. Now I'd like to open up the floor. So I'll go back to gallery view. If anyone has any questions, please.
I have a question.
Yes, Randy?
Yeah, I got a question for Anthony Klemencic. Hi, Anthony. Can you hear me? Hello. Hi.
Yes, we can hear you.
Yes. So to make a bulletproof will, you will need to have a primary will, a secondary will, attorney for personal care, and attorney for property, right? Does the attorney for property for personal care can be the same person or could it be different?
You're on
Tony,
mute,
please
Dad.
unmute.
That specific question about powers of attorney, they don't have to be the same person. No.
Okay.
You got the choice, but your preamble, when you said make a primary will.
Bulletproof will, yeah, because you can get basic wills online, which I find
Not recommended.
Not recommended, no. So yeah.
Now I'm prejudiced because I'm, I have a conflict of interest in answering you that way, but
Okay.
90%. I've had tons of people come in and say, well, I bought this will kit, but I don't know how to fill it out. Can you help me? I said, no, I'm not going to help you fill out a will kit. I'm going to be happily doing you a proper will that is not on a kit, right? With blank spaces in it.
Okay. And
Anyway,
when's the,
you have
when's the,
flexibility, Randy.
my other question is, one other question. When is the best time to make a will? Like, I'm 41 years of age with 2 daughters.
How about next week?
Okay.
I
Okay.
think, Randy, you're unlikely to make one will in your life, okay?
Okay.
You make
Yeah.
one now for the lifestyle you have now,
Yeah.
and for what you want to protect against should you get hit by a bus tomorrow.
God forbid.
From
God
now,
forbid.
you'll
Okay.
be changing your will and saying, well, maybe at this stage, my plans are going to be a little different, right?
Okay. One other question. And to make changes to a will, like to add a child or whatnot, what does that cost? Like if I wanted to add or.
Well, if you're just making a small change, adding a
Yeah.
name, taking a name out, and we've already gone through your portfolio, we've already gone through that initial
Okay.
of your situation, well, then, it might be $500 or something to do just a little change. But the real work comes at the very beginning when we identify what you got, what you do, who your relatives are, et cetera, et cetera. That part is the meat of the whole job, not just that 3 or 10 page document called the will.
Okay. One last question. Honestly, last question. I've been listening to Ted Wallachin. Do you know Ted Wallachin from previous from News Talk 1010? And he's a host for avoidprobate.ca. What are your thoughts on that? Can I look into that for resource? Is that a good option?
I'm not familiar with that. I'd have
Okay.
to look into it, and then you could call me.
Avoidprobate.ca. Yeah.
Yeah, call me tomorrow or the next day, and I'll happily look into it and give you my opinion.
Okay. That's all the questions. Thank you.
Okay, thank you, Randy. Any other questions? I think we have a lot of financial people on board today, and I'm sure there's comments that maybe some of you would want to add. If there's any other questions, please contact me at info@canslow.com, and we'll definitely address everything that comes on. So if that's if everybody's okay, no more questions for now. So thank you for participating in today's Canadian Slovenian Chamber of Commerce Business Insights. We hope you'll join us again soon, and let us know if you have an area of interest that you'd like to explore and to share. Thank you to our panel, Mr. Anthony Clemencyk from Anthony Clemencyk Barristers and Solicitors, Mr. Stan Konda from Konda Financial, and Mr. John Doma from Bateman McKay CPAs and Business Advisors, who have provided us with so much valuable information tonight. We'll share the YouTube link for the video of this presentation as soon as it's posted. If you have additional questions and comments, please contact us by emailing info@canslow.com or contact our presenters directly. So let me just share this briefly. Or not.
Hey, Sonia, I'm wearing my Chamber of Commerce hat. If anybody knows any businesses that would benefit from joining the chamber, we would really appreciate that. Get the word out there. We're trying to do what we can to create, harmony between our companies and sources that way. So again, I know Sonia will be more than happy to, help you get them on board with our organization. Thank you.
Yeah, and I also want to thank Chin's Glas Kanadski Slovensko FM 100.7 on Saturday, 8 o'clock to 9 o'clock. Just a reminder to everybody in our community, we encourage the support of the VSKO and the Canadian Slovenian Radio by advertising or sharing your announcements. So for more information, please contact the program director. That's Maria Jonishuk at maria.jonishuk@gmail.com. And she also publishes her phone number. So I'll also send the slide out because we encourage that we support our community. As small as it is, it's important that we're all supportive of each other. So on behalf of the Canadian Slovenian Chamber of Commerce, we hope that this webinar encourages you to complete your estate plans and to please contact the professional advisors that are appropriate for your needs. I'll also take you back to our canslo.com website. We have a directory there of Slovenians in our community that are financial advisors, accountants. We have a very good reach in our community of professionals that you're very encouraged to contact. So thank you for tonight. Thank you, everyone. Lahko noč. Goodbye.
Good night.